Today, I am joined by Randy Von Royen and Jan Arsenal, and they are our investment experts at TrustPoint. And we asked for a number of questions, or we asked for questions from our audience prior to today's event, and we received a number of those. So I appreciate that, and thank you. And so during this event, we also are inviting you to ask questions along the way during the presentation, and we will make every attempt to answer those at the end of today's session as time permits. So without further ado, I think we're going to go ahead and get started on the topic at hand. So a lot has happened, and who would have thought in such a short time that a pandemic would have infected over 23 million people across the globe, resulting in over 800,000 deaths. That a global depression would unfold in a matter of just weeks. That the US GDP would collapse almost 33% in the second quarter. That unemployment would skyrocket to over 10% from very low numbers at the start of the year, and that the Fed interest rates would be at 0%. All this happened, and again, in a very short amount of time, but yet over the past year, stocks are up over 10%. So to talk about these hot topics for investors, we are calling them the main 4 P's of what's on investors' minds is the pandemic, the policies, the politics, and how that affects your portfolio. So we're going to go off video so you guys can focus on our information. And again, we'll come back on during the Q&A session at the end, but we're going to go ahead and let Jan get started with the first chart.
Thank you, Angie, and thank you all again for listening in today. We are glad to have you with us. As you alluded to, Angie, I think it's been quite a year, and it certainly feels like there's a disconnect here between the economic pain caused by the pandemic and the stock market performance as of late. So Randy and I will do our best today to reconcile that disconnect. And I think the best place to really start our conversation is to talk about the virus itself. Now, just last week, we learned that COVID-19 is now the 3rd leading cause of death for Americans this year, only behind heart disease and cancer. So a pretty depressing statistic, but I think it's encouraging to see that some progress has been made as well. If we go back to March, the shutdown of the US and the global economy, for that matter, was really something no one had expected. And to a large extent, it was a function of not knowing how widespread the virus was. So in order to flatten the curve, and I think we all remember that term, right? In order to flatten the curve, we needed to pursue aggressive containment measures, and it's exactly what we did. But I think since then, we've got a lot better at managing the virus. And as the next chart shows, the second wave of cases that we experienced in the early part of the summer, which would be in blue on the chart here, did not lead to a second wave of fatalities. And that is very, very important. Now, to start with, people are now diagnosed earlier, which allows for faster treatments and recoveries. The treatments themselves are better, and more recently, the people most affected by the virus have generally been the younger generation. The generation we know is more prone to recover from the virus. And I think as a society, we've also developed ways to better protect people most at risk as well. So this is all good news. Obviously, the fight against COVID-19 is not over yet, but breaking that link between cases and fatalities was important, because as the next slide shows, from a macroeconomic standpoint, now studies have demonstrated that people's behavior is more influenced by the number of deaths in the county they live in than by the number of people actually diagnosed with the virus. And that makes sense, right? If people feel like they won't die from the virus, they will be more willing to engage in their normal daily activities. So going forward, based on what we know today, we believe that the bar to full lockdowns like we experienced in March, April is really, really high. What is more likely, in our opinion, is a continuation of localized measures designed to slow down the transmission of the virus in the hotspots, wherever those are. And the key takeaway here is when we think about equity markets being forward-looking, equity markets have really embraced this idea that economic growth may be slow for a little longer until we get a vaccine, but it won't come to a stop again. I'll talk about progress made on a potential vaccine in a minute here, but before I do this, I would like to ask the audience to tell us when they think the first working vaccine will be available for broad use amongst the population. So said otherwise, we want to know when you think the FDA will give its blessing to a vaccine that can be used for mass distribution. So we'll give everyone a few seconds here to answer the question. All right, the results are shown here. Not a surprise to me. In fact, the same question was asked recently in the US across a broad range of people. It's a survey that was conducted actually by Deutsche Bank. So if we can show the survey here, you're seeing the results. 75% of people believe a vaccine would be available in the next 6 to 18 months. If I look at the result of our survey, 76% of people actually believe they will be available in the next 6 to 18 months, which is spot on. I think it's the right time frame to think about for a vaccine, again, becoming available for broad use. So we'll take a deeper look, a closer look at this. Historically, it has taken 5 to 10 years to develop a vaccine, 5 to 10 years. We have all hands on deck here with the government and the private sector working together to essentially get this done in about a year. If we look at the next slide, we already have some vaccines, in fact, in phase 3, which is where you have thousands and thousands of people across a broad section of age and condition enrolled in a study. And the early results from phase 3 for some of the leading vaccines are expected as early as September of this year, 2020. And as early as October, we could get, we believe, emergency use authorization approval by the FDA for high-risk patients, with broader use approval in the first half of 2021. And what we've heard is that if the data is really good here in the fall, a Q1 2021 broader use approval by the FDA is possible. Now, the manufacturing ramp up is also important here, and it's already on the way with many firms collaborating, working together to make sure that we can produce enough of the vaccine as quickly as possible once approved by the FDA. However, as we heard from Dr. Fauci and others, I believe it was just last week, the process of getting the population vaccinated will likely drag well into 2021. So between now and the end of 2021, life may not be as it used to be. But again, from a market standpoint, markets are forward-looking and have embraced really the idea that a vaccine should be available relatively soon. There's another reason why markets have been rallying in the face of weak economic growth, and that reason is because of governments. If you look at the next slide, you'll see that governments around the world really stepped in very aggressively this time to make sure struggling households and businesses have enough cash to meet their obligations. And that has helped tremendously. As the chart shows here, compared to the 08-09 crisis, the response from governments has been quicker, more significant in size, and open-ended as well, meaning that if more money is needed, more is likely to be provided. The Federal Reserve has also played an important role. If we look at the next slide here, the actions and the words of our central bank, the Federal Reserve, have led to a sharp decline in interest rates and in credit markets, a tightening of spreads. As a result, what we've seen is the availability of credit increasing and the cost of capital declining. So we've seen more credit being available with the cost of the capital declining. And that has helped also confidence. Confidence in the financial system was quickly restored. And interestingly, if you look at the chart here, many of the programs that were announced in March, April still have plenty of dry powder, as the utilization rate of these programs is still low. And the utilization rate is low because private market participants have been willing to provide liquidity and have been willing to do so because they understand that the Fed has their back. So interestingly, by simply indicating to markets that it is ready to do whatever it takes to help the economy, the Federal Reserve has not had to do much at all this time around. All right, we're going to move on to the third item on the agenda, and it is politics. And obviously with the presidential election coming up here, it has become a more popular topic of conversation as of late with clients. Before I ask Randy to provide his thoughts, we have one more poll question for our audience. So we'll ask you to answer the question here. Are you worried, not worried, or neither about the upcoming 2020 election? All right, we have 78%. So 78% people worried about the election. Again, spot on. Again, the same question was asked recently nationwide. If we can take a look at the next slide, you'll see that nationwide, 73% said they are worried about the election. So the 2020 election is in fact now the #1 concern, with a second wave of the virus falling #2. So Randy, how concerned should we be about the 2020 election in your opinion?
Hi, Jan. Good question. I agree with the survey. With constant political commercials and the nation's polarization at its highest when it comes to political parties, it makes sense that the election is top of mind, to say the least. But before I try to answer that question, for those of you that attended our Charts and Chatter events, you know when we cover politics, we like to remind everyone that our comments are not intended to support or oppose any political party or candidate. It is our job to evaluate what various scenarios might mean for the markets, the economy, and certainly for our investment strategies. We realize that many factors contribute to who a vote will be cast for beyond how the market might be affected and how your portfolios might perform. Now, with that out of the way, back to Jan's question. Should we be concerned? You know, from the very simplest standpoint, I would say you should be concerned less than many think. If I could summarize the political information I want to share today, it's intended to encourage a longer-term view when it comes to politics and your investments. Ultimately, making a drastic investment decision on who is in the White House or who controls Congress might be detrimental. So we hope the following information can help you come to that conclusion as well. First, I'd like to take a look at how the equity markets have performed in various government leadership scenarios. In particular, a couple generalizations that could be applied this year that don't seem to hold water. So what you're looking at is various scenarios in the actual average return for those scenarios. The first one I want to cover is one of the more common perceptions that markets tend to perform well under Republican presidents. And a lot of times this is really the idea that their policies are business friendly. So when we look at that particular perception, you can see here going back quite a ways to almost 150 years, the average return with a Democratic president in the White House is 7.5% and a Republican 5%. Now I've seen a lot of shorter analysis, shorter time frames that narrows that gap quite a bit, but still the message is the same. The other one I wanted to touch on is markets like government gridlock. And this is the idea that limited government activity equals less uncertainty. And as you can see here, that's highlighted under a split Congress, is actually one of the lowest return out of all of these different scenarios. And one that's could be coming up, or at least the way the polls are reading today, we could have a blue wave, so to speak, and have a Democratic Congress and president. And here again, you'll see that is among the higher returns, although very similar to a red wave, which is just about the same return annualized. Again, from a market's perspective, we see politics potentially affecting markets in the short term, but so many factors contribute to market performance in the short term and long term, and government leadership is one of those many factors. Now, ironically, markets don't care if you don't like who's currently president. Taking a little step further, history has shown voters don't even have to like who the president is for markets to perform well. Looking at a continuous Gallup approval poll for US presidents going all the way back to JFK, as highlighted in red, the market has performed the best at lower approval ratings. I think what's important to glean from this is that who lives in the White House or who controls Congress may not be a driving force in where the market goes next. Now, what the market does care about is certainly the uncertainty related to the upcoming election. This chart shows the average monthly VIX in election years. The VIX is a volatility index that measures the level of negative sentiment in the market. It measures the market's forward-looking expectations for volatility. Shown here, it's typical for volatility to increase in the months leading up to the election and then settle down post-election after a victor is known. Again, planning to drastically alter your investment strategy after election results can also be a little bit too late. Now, this year might be a little bit different. We've seen volatility index declining steadily as we've seen improvements in the economy, where earlier this year we saw the VIX spike to near record levels. What markets also care about is especially when the incumbent party loses. So what you're looking at is the S&P 500, again, in election years. This chart shows in blue the average path of the market when the incumbent president maintains the White House, compared to in the gold color when the incumbent party loses the White House. Like the last volatility charts, months leading up to the election show some downward pressure. On average, when the incumbent loses the White House, there is a 5% decline. Doesn't sound like much considering what we've been through earlier this year. All right, I'm going to switch gears into the last section, the portfolio. More specifically, I'd like to cover some of the market conditions that we are watching closely and are a meaningful part of our investment strategy discussions. I'm also going to share with you some of the portfolio changes we've made over the last couple of quarters. So first, I want to take a look at the challenges in the bond market. The onset of the pandemic caused a sharp decline in investment grade bond yields, and namely U.S. Treasuries. There was a flight to safety due to the economic shutdown and all the uncertainty associated with the pandemic. As this chart shows in blue, the yield on the investment grade bond market has now fallen to an all-time low of just above 1%. At the same time, in red, this investment grade bond index has risen over 8 years. Duration measures the sensitivity to changes in interest rates. The higher the duration, the more volatility there is. In our opinion, the investment grade bond market as a whole offers low future returns in the form of income with a 1% yield, and it will also be more negatively impacted by rising interest rates in the future. As a result, we need to look beyond the investment grade bond market to further diversify and support future returns. So after cutting this exposure late last year in non-investment grade bonds, in May of this year, we reintroduced non-investment grade bonds in the form of high yield bonds, as well as investment grade corporate bonds. These both have contributed nicely to the return since May. Additionally, we swapped out our high quality treasury exposure for TIPS, Treasury Inflation Protected Securities. During the economic shutdown, inflation expectations fell to the floor, and also along with oil prices. This depressed inflation expectations, but tips have benefited nicely from the recovery from those low inflation expectations. This helped continue strong returns in our high quality exposure, moving from treasuries, which have slowed down in return, to tips in the last several months. So now I want to shift to the equity markets. Stock prices and earnings, a growing disconnect, as Jan mentioned earlier. The chart shows stock prices in green over the last several years and forward earnings expectations in the gold color by the dotted line. This first of all, in the upper right, this illustrates the V-shaped rebound that we've experienced. Considering all that we've been through, as Angie started with in the beginning, year-over-year returns are now positive 10%. We often say that many factors can influence stock prices in the short term, but corporate earnings drive markets long term. In fact, you can see in several occasions that stock prices in the green line anticipated better earnings estimates, highlighted by the red arrows. I think the most obvious one is here in the third. Stock prices started to rise well before earnings expectations started to rise. Over the last 100 years, of the 17 bear markets, which is defined by a 20% decline or more, this has been the fastest trip into bear market territory, as well as the fastest trip out of bear market territory. But the divergence between earnings and stock prices is obvious. So what does this mean for valuations? When we consider how expensive or inexpensive markets are, we often talk about PE ratios, or price to earnings ratios. Again, what you're looking at is over time, on green, the US market's PE ratio, and in the gold dotted line, the international market's PE ratio. With depressed earnings and high stock prices, on aggregate, this means there's high valuations, which is illustrated by the far right, the levels on the far right. In fact, we haven't seen valuations at this level since 1999-2000 stock market. Now, there are a few explanations to consider for these high valuations. First, certainly, as Jan mentioned earlier, the monetary and fiscal stimulus has helped bridge the economic gap during this pandemic. The response for the pandemic has been quick, meaningful, and open-ended. If you think back to the great financial crisis, the Federal Reserve and the government kind of piecemealed out the stimulus packages. We're going to go do this until then, and then this until then. I think there's a total of 4 quantitative easing packages. Well, this time everything was brought out at once and really brought stability, especially to the fixed income markets and the markets as a whole. Also, markets are forward-looking and see continued improvements. Markets look beyond the negative economic impact of the pandemic. And then last, I want to mention a more technical, or it gets into how stock valuations are priced. US stock prices and real yield movements. So what you're looking at on the top graph is the S&P 500 forward PE, or PE ratio, as well as the 10-year TIPS yield inverted. The TIPS is a proxy for real yields. And we inverted to really highlight the relationship between stock prices and real yields. The negative impact of the short-term decline in earnings that we looked at on previous slides is not as important for equities as the impact of lower yields has on equity prices. What does this mean? Lower rates or lower interest rates can support higher stock valuations. Now, if you think about it, what's ironic, it appears that as a result of the pandemic and the aggressive actions of the central banks to lower yields, equity valuations and stock prices have had an indirect positive benefit. And then lastly, market composition also plays a big role. So here we dissected the global equity markets by industry and top holdings, specifically those industries that have been most negatively impacted in red and those that have been most positively impacted or benefited in green. First of all, looking at in red, industries like airlines, department stores, casinos, hotels, and restaurants, these are well covered by the media and also household names. These are names we see, company names we see in our daily lives. However, these are not a very significant part of major market indices. You can see, for example, airlines, which certainly we've been hearing a lot about, is only 0.06% of the overall market. In the US, it represents in the S&P 500, 0.18%, not even 0.2% of the overall market. market. So these 6 industries equal about 5% of the overall market. But then when you move in those that have benefited, which have really been the different technology companies as well as healthcare, you can say represents a much bigger part of the global market, almost 29%. And again, as far as the S&P 500 is concerned, this equals over 40% of the S&P 500. This has allowed markets to improve because of larger industries performing well and proving that they can perform well even during the economic shutdown. Technology and healthcare were a big part of that. To the right, mega tech is also driving markets, which we're hearing a lot about. In the broader global diversified benchmark that you see here, there are a few large names that equal 12.3%. There's actually over 3,000 names in this benchmark, and just 5 equals 12.3%. And then you've probably heard things on as far as it relates to the US markets, where these large tech firms make up almost a quarter of the S&P 500. To give you an example of their dominance through July this year, these 5 names were up an average of 35% year to date. The remaining 495 companies in the S&P 500 were down 5%. So before we end and take some questions, I wanted to give you an idea of what we've been doing in regards to our equity exposure. You know, we started this at the beginning of the year underweight equities, and more recently we moved to neutral equities, and we accomplished this by adding to international equities. And just to name a few of the reasons that we believe international equities have some potential, I'll read off some of those very important items. They, first of all, a continued weak dollar is supportive of international stocks, and we see that continuing. Valuations are more attractive relative to the US, and non-US stocks tend to lead out of economic rebounds. And unlike the great financial crisis, many of these developed countries are now willing to do fiscal stimulus, where if you think back, places like the UK and certainly Germany were very apprehensive in doing any type of quantitative easing or fiscal stimulus. And then lastly, these companies do not have as a direct impact from the US election, at least not in the short term. I think this still leaves us in a position to take advantage of increased volatility in the next few quarters. But I wanted to mention that we are now neutral on equities. So with that said, I am going to turn it back over to Angie.
All right, thank you, Randy. And we're going to take some Q&A right now, or some questions, and hopefully get some answers. And just as a reminder, you can use the Q&A function to send the presenters a question if after reviewing this information and hearing this information, it jogged a question for you. But the first one that came in is, Randy, you just recently talked about the tech stocks being strong performers and having those high valuations. Is that a concern for investors?
You know, I think it is in some respects. You know, first of all, you know, you think about having a top-heavy market, there's certainly some vulnerability to that. But with that said, I think there's also the idea of market rotation or sector rotation within the market. So yes, these technology companies have really helped propel the market to where we see it today. But we've also seen little signs of this rotation. I think it was back in late May and early June, and as well in August, where we saw small caps, which haven't been getting much attention, small cap US companies do quite well, but nothing's really stuck. So I think there are concerns. I think overall the health of the market would be better if we see some other sectors and other types of equities do better. But in general, you know, I certainly don't want to sound like we're complaining about this, because it has helped driven markets and certainly a significant part of the rebound that we've seen.
Absolutely, thank you. Another question is, and I know you guys have gotten some questions in the office as well about gold. Do either of you want to speak on gold? And it's had a success over year to date. Many investors are asking about that.
Yeah, sure, I can take that one, Wendy. Gold has always been a great risk diversifier in the sense that it behaves very differently than stocks and bonds most of the time. And to your point, Angie, the returns have been also quite good, not only just recently, but if you look at the last 20 years or so, I think gold has actually performed better than stocks. So Gold is in favor right now. It tends to be in favor during periods of greater uncertainty. And we've heard more about this idea that with the central bank being very aggressive, now some investors may have lost confidence in the dollar as a store of value. So on the negative side, though, the issue with gold is that it's always difficult to value gold. So gold doesn't pay a coupon like bonds do. Gold doesn't have a dividend yield like stocks do, and gold also doesn't have a meaningful industrial use like oil or copper do. So it's difficult to value gold. There's some models out there that are available. The one that we think has worked the best is a model looking at the correlation between real interest rate and gold. And Randy talked about real yield and tips as a proxy for that. And it shows that at current level, gold is not cheap, gold is not expensive, but probably fairly valued. So we're not against the idea of holding gold in portfolio. In fact, we have facilitated the purchase of gold for some clients. So if you're interested, just reach out to your relationship manager. But typically, we would recommend limiting the size of the allocation to no more than 5% of the total portfolio.
All right, great, thank you. We did have a question about financial companies and how do you expect them to perform as we climb out of COVID time? Do you, but interest rates to stay low long term. Do you guys want to comment on that or any insights into that question?
Yeah, I think that's a really good question, and it somewhat speaks to the last part of what we talked about. You know, financials really fall into the value side, and we've seen really one of the, at least matching the great discrepancies between the growth companies, large cap growth companies, and large cap values. It's about 35% year over year. And again, matching kind of the greatest difference we've seen in the past. Typically, value companies, including financials, lead out of economic, out of recessions, and so but they really haven't seen that quite yet. Again, we saw a few different points in this year that we saw some attention go that direction, but we haven't seen it yet. We would think that there would be a rotation. We would think that value companies, especially at these extreme differences between growth, would start to get a little attention. And therefore, we should see those companies, if we see a rotation, those companies do a little bit better. I don't know if you have anything to add to that, Jan.
No.
Great. Another question about GDP growth for the next few years and what you can expect based on if that changes with the outcome of the election in November.
Yeah, good question. And then I came in advance, so I did write some notes down. But just for the U.S., the street's really putting that for 2021 a GDP of 3.7%, and for 2022 of 2.8%. Those are a little bit lower than globally. But how might that be affected? We don't think that the street estimates are going to change much with the results of the November election. That kind of coincides with the message that I was giving earlier. I do think some comments come to mind, though. I've been reminded by a colleague a couple times in the last week that all of the things that are said on the campaign trail and all of the political agendas that are talked about, not all of it comes to fruition once there is a new person or an incumbent in the White House. I think that's an important part. But then as we think about if, for example, if Biden did win, which are what the polls are showing and the betting markets are showing right now, there's a lot of uncertainty with that too. He's been a moderate Democrat over the years. It's still, I've seen a lot of opinions that he will not give up the economy to take on a more progressive agenda. Again, that remains to be seen. I think his choice of VP kind of supports that. And then, really there's the idea that, again, I've been here a few different times, is that President Joe Biden might be good for the economy, or better than some think, but maybe not good for the market. And I think there's two distinctions there. I mean, there could be infrastructure spending, again, a little bit more moderate orientation to the policies that he takes on. But again, all that remains to be seen as things unfold. And certainly a big part of that is how the economy unfolds and recovers from the pandemic, and if some of those initiatives can actually take place.
All right. Well, thank you very much for joining me today, Randy and Jan. Do you want to have any parting statements for our audience? I'm throwing them off a little. They haven't thought about this, so.
No, I appreciate the questions as well. I think certainly this is an interesting time. It always is. 2022, or excuse me, 2020 will certainly be remembered for a lot of different reasons. And in the next few weeks, I'm sure we won't be short of new turns and twists.
Angie, if I can just address, I'm just looking at some of the questions that have come through here, and there's one here I think that would be important to address. It's asking specifically about the performance of conservative growth going forward. We've had a lot of questions on expected returns going forward, whether it's for a conservative growth portfolio or a higher growth portfolio for that matter. And I think Randy covered the high quality bond market really well in explaining that we are seeing certainly more duration risk, more interest rate risk in the high quality bond market and lower yield or lower returns going forward. But there's certain ways in the fixed income market still today where you can add to returns without adding unnecessary risk. And as a result of the pandemic, we have seen a widening of spreads, although again, the actions of the central banks as of late have led to a tightening of spreads. There's still good value in some segments of the bond market. So this is one way to add value above and beyond maybe the 1% and that high quality bonds will provide you. When it comes to equities, and Randy talked about equity valuations, but he also talked about some of the reasons to believe that equity valuations may stay elevated for quite some time. So when it comes to our expected returns for equities going forward, for us, they're still in the kind of the 4 to 7, 4 to 8% range. We would expect domestic equities to be maybe closer to the 4, and international equities and emerging market equities to be closer to 8. So obviously in sizing positions that we have in portfolios, we cannot put all of our clients' money in the international stocks and emerging markets to get closer to that 8%. We have to maintain a balance. But when we think about the construction of portfolios, we obviously think about these things as well. So again, I wanted to address this point because we've got a lot of questions as of late about future expected returns given valuations level and given concerns related to not only, again, the election, but COVID-19 as well.
As you might have noticed, Randy is in the office. We have a very small group of people who are in the office, and we're not yet meeting clients in the office. But please pay attention to email and your inbox, as well as out on our news and insights as things change rapidly, as you know. But for Randy, Jan, and myself, I just wanted to finally say, and from all of TrustPoint's team, there's a lot going on, and not only are people being impacted by COVID, but our thoughts are also going out to those who are being affected by tropical storms right now, as well as fires in the West. So there's a lot happening, and we just wanted to let people know that we're thinking about them. So in the meantime, until we can see you again, thank you and take care. If you have any questions, please reach out to us at any time.